Welcome to another deep dive. Today, we're navigating the really intricate landscape of the global cryptocurrency market. This is as of July 1st, 2025. Our focus, well, it's the rapidly evolving narrative of tokenization and also the incredibly proactive regulatory shifts we're seeing, especially coming out of places like Dubai. It's a space where, macro level factors and these groundbreaking innovations are constantly shaping what's next.
Exactly. And our mission for this deep dive really is to cut through all that noise. We've got a diverse stack of sources. I mean, everything from fresh market data, specific project announcements, right through to a pretty significant regulatory report. We're here to extract those crucial nuggets of knowledge, helping you understand what's truly important amidst this, constant flow of information.
Okay, let's unpack this right away then. A market snapshot from July 1st, 2025. The global crypto market has seen a bit of a dip, down by about 3.01% in the last 24 hours. And what's particularly noteworthy, I think, is that ETF inflows have also fallen quite sharply. They're now at a, pretty modest $15.5 million. However, on the volume side, the total cryptocurrency market volume stands at $89.7 billion, which is actually up 12.07% over the past day.
Right, so volume up, price down, ETF inflows low.
Yeah, this combination, it paints an interesting picture, doesn't it? It kind of suggests institutional players might be in a bit of a wait-and-see mode, perhaps pausing their more aggressive entries. Yet that overall volume increase, it signals that retail and maybe more agile traders are still very active. This divergence in sentiment is a key takeaway. And what's also fascinating is the activity on decentralized exchanges, the DXs. Their 24-hour volume has seen a really significant surge, hitting $18.58 billion.
Wow, $18.58 billion just on DXs.
Yeah. And the total value locked, the TVL, this is the total amount of crypto assets, deposited and locked into DeFi protocols. It's sitting at $113.47 billion. DX dominance is climbing too, up to 48.44%. Among the leaders by 24-hour volume, PancakeSwap really stands out. It's at $11.18 billion.
Huge number.
It is. Closely tied to the Binance BNB chain, which shows, the second highest activity after Ethereum. Then you got Uniswap falling, but it's quite a bit lower, actually, at $2.35 billion. That's roughly a fifth of PancakeSwap's volume. After that, we see Radium at $697.97 million, Zora at $544.82 million, and Pumpko's at $493.04 million.
Oh, interesting. But you mentioned stablecoin activity hasn't really picked up pace.
That's right.
The leading volumes there are USDT at $62.43 billion, Circle's USDC at $8.62 billion, and FDUSD at $4.14 billion.
And this data point, it's actually a crucial market matrix. See, when overall prices are going down, like they have been slightly, but stablecoin volume increases, it generally suggests people are converting their crypto into stablecoin.
It's a digital cash, basically.
Exactly. Rather than cashing out into traditional fiat currency, it's a sign they're likely looking to stay within the crypto ecosystem, waiting for better opportunities rather than exiting entirely.
Okay, that makes sense. So shifting to the current market caps and prices. Bitcoin's market cap is sitting at $2.12 trillion. Ethereum's is just shy of the $300 billion mark at $299 billion. Price-wise, Bitcoin is trading at $107,130. That's down about 1.3% in the last 24 hours, but still up over 2% for the week. Ethereum is at $2,485, down slightly, less than 1% in 24 hours, but up almost 4% over 7 days. And Ripple's XRP is at $222. That's actually up 1.36% in 24 hours and up over 4% for the week. Bitcoin dominance currently sits at 62.20%, with Ethereum holding 8.76%. So these numbers, they give us a clear snapshot of the market state right now. But beyond the charts, there are always these macro factors at play, right? Take, for instance, the political landscape. Our sources indicate that a political development, what's being called the Trump One Beautiful Bill, is expected to pass either today or tomorrow. And there's apparently a high chance it might be signed into law on July 4th. Now, while a direct, linear correlation isn't always guaranteed with these things.
No, definitely not.
These high-profile legislative moves can significantly shift market sentiment, particularly around regulatory certainty, which of course influences investment decisions. It almost acts as a kind of bellwether for broader political acceptance, or at least direction, for crypto.
Okay, so with that market snapshot setting the stage, it's clear the crypto world is, dynamic. But what's really fueling the next wave of innovation? Lots of people are saying it's this completely new narrative unfolding around tokenization.
That's absolutely right. You look at someone like Larry Fink of BlackRock, for instance. He expressed excitement not just about the Bitcoin ETF approval, which was huge, but specifically about the future of tokenization right after the Bitcoin halving. That really signaled a significant shift in focus for the industry, moving beyond just thinking about pure crypto assets. So what does this all mean for the average investor, maybe? How quickly can this bridge between traditional and decentralized finance truly be built? What are the biggest hurdles? I mean, essentially, tokenization acts as this bridge between TradFi and DeFi, right? Its goal is to enhance transparency, efficiency, accessibility in financial asset markets, basically enabling faster, more open, and programmable capital movement. It's really about bringing real-world value onto blockchain.
Exactly. It's taking things we already understand, stocks, bonds, real estate, and making them work on these new rails.
Okay, let's dive into some specific projects then, the ones leading this tokenization charge. First up, Kraken. One of the oldest crypto exchanges, obviously. They've launched tokenized U.S. stocks and ETFs for eligible non-U.S. citizens. Now, get this. It's powered by backed finance using their back token, and it's built on the Solana blockchain.
The Solana, interesting choice there.
Yeah. Kraken's starting with 60 assets, but they plan to expand access to 140 countries. This offers 247 trading, self-custody, and crucially, DeFi integration, so users can move, spend, or even borrow against these tokenized assets. The clear goal here seems to be democratizing global investing, removing intermediaries, making capital markets borderless.
And it's worth maybe just briefly noting Kraken's interesting past move. Remember, they left Abu Dhabi. This new push into tokenized assets, well, it could hint at a strategic reevaluation of their presence in the region, maybe even looking towards Dubai again as a potential hub for these new financial products. Who knows?
That is an intriguing possibility. What would be the strategic advantage, though, for them to return to a region they left, especially with so many others now piling in? Anyway, next up, Robinhood. They've announced a major crypto expansion, launching stock and ETF tokens in Europe. They've revealed a Layer 2 blockchain and apparently plan to migrate these stock tokens to their own lab blockchain, which they say is specifically optimized for real-world asset tokenization.
Building their own infrastructure for it.
Yeah.
Smart.
Seems like it. And on top of that, they're rolling out perpetual futures up to 3x leverage in the EU and staking, starting with Ethereum and Solana over in the U.S. For European customers, this means access to over 200 tokenized U.S. stocks with zero commission, 247 availability, all focused on that user-friendly experience Robinhood is known for. Then there's a different kind of player, Shake.io, a new platform built in Switzerland focusing on tokenizing luxury real-world assets. Think properties in Dubai, Rome, Bali, high-end cars, fine arts, that kind of thing. It's powered by AI and blockchain, and they've launched a pre-sale of an Ethereum-based token, offering fractional ownership with a remarkably low entry barrier, just $100. So fractional ownership of a luxury car or a villa in Bali for just $100. It almost sounds too good to be true, doesn't it?
It does raise an eyebrow, yeah.
They promise quarterly payouts in stablecoins or Ethereum, plus bonuses and raffle rewards. They claim they're making premium investment accessible to like 99% of people with NFT-backed deeds and DAO governance.
Indeed. And it's really crucial here to acknowledge that our source material includes a strong note of caution regarding potential rug pulls with new ventures like this one. It just emphasizes the critical importance of personal due diligence. Seriously, this is absolutely not financial advice, but it's a vital reminder. Always, always do your own research, especially when promises seem exceptionally generous or, well, almost too easy.
A critical point, especially in this space where things move so fast. And staying in the region, specifically Dubai, there's Bison Link, a Dubai-based company. They've just secured $1 million in private investment specifically for building next-generation infrastructure for tokenized finance. They're focusing squarely on real-world asset tokenization, bridging TradFi and DeFi. They're headquartered in Dubai DMCC, which, as you know, is a leading global hub for blockchain and crypto innovation. Their core goals: enhancing transparency, efficiency, accessibility in financial markets, and strengthening operational frameworks for institutional adoption. They're really positioning themselves as the infrastructure for compliant, yield-bearing, real-world asset products targeting institutions, fintech firms, and those digital native treasuries. Okay, and now for a truly strategic development, I think. Ripple has made a significant move. The XRPL Ethereum virtual machine, or EVM, sidechain mainnet, is now live. This is being described as, quote, smart contracts meeting XRP's reliability.
Yeah, this is big news for them. What's particularly noteworthy here is that this move brings Ethereum compatibility and smart contract functionality to the XRP Ledger for the very first time. Technically, it's built with partners like Peersyst Axelar and Squid. These are key infrastructure providers enabling this crucial bridge. What it means is developers can now build EVM dApps, the kind usually built for Ethereum, while still benefiting from XRP's, renowned speed, security, and its 12 years of stability. And XRP itself serves as the native gas token on this sidechain.
Right, so the benefits seem clear. Faster block times compared to maybe some other EVM chains, low fees, which XRP is known for, compliance-ready infrastructure, and access to potentially over 6 million XRP wallets. This really opens the door to new possibilities like lending, more robust tokenization efforts, and broader DeFi integration within that XRP ecosystem.
Absolutely. But this raises a really important question, one that many people are asking. Can XRP finally compete with Ethereum now that smart contracts are live via this EVM sidechain?
Yeah, that's the million-dollar question, isn't it? Or maybe trillion-dollar, given the market cap.
Maybe. Well, while it definitely brings Ethereum compatibility to the XRP ecosystem, it doesn't necessarily make XRP a direct competitor to Ethereum. Not really. You have to remember the significant market cap difference, for one, but also the fundamental design philosophies. The XRP Ledger is fundamentally built for speed, low fees, and payments. That was its core purpose. It wasn't necessarily designed for complex, decentralized applications in the same way Ethereum was from the ground up.
So the sidechain isn't changing the core ledger.
Exactly. The EVM sidechain acts more like a bridge than a full transformation. It's technically separate from the core XRP ledger and connects via interoperability tools. So think of it more as a strategic upgrade for Ripple. It allows developers using Solidity Ethereum's language to build dApps that can use XRP as gas and tap into its existing ecosystem and user base. It's not really a total ecosystem shift aimed at competing head-to-head as a general-purpose smart contracting platform like Ethereum. And it's also worth remembering that distinction of the XRPL works on a consensus protocol. It's super fast, energy efficient for agreeing on transactions. Very different from Bitcoin's old proof of work or Ethereum's proof of stake. That core difference drives its speed and low fees.
Okay, that really clarifies the distinction. It's strategic enablement, not necessarily direct competition in Ethereum's core domain. So while Ripple is enhancing its capabilities for broader use, where is the actual decentralized application activity flourishing today? Let's maybe zoom in on a different ecosystem for a moment, specifically Solana. When we look at the top 5 decentralized apps on Solana, by the fiat value of incoming token transfers from unique active wallets, the numbers are quite impressive. Pump Fund leads by far at $37.3 million. GTO comes in second at $10.51 million. Then you have the exchange at $7.75 million, Pragmatic at $6.87 million, and Radium, the DEX we mentioned earlier, at $3.48 million in this specific metric.
Yeah, and just to give you some context on those numbers, our sources indicate that the top dApps on, say, the Cardano blockchain, for comparison, are significantly lower. We're talking values less than $100,000. So it really highlights the current disparity in decentralized application activities across different Layer 1 ecosystems right now. Solana's clearly got a lot of buzz and usage in that area.
Definitely a stark difference. Okay, so as we've explored these groundbreaking innovations, especially the ones eyeing institutional adoption like tokenization and infrastructure plays, it's critical to consider the regulatory environment, right? Which brings us perfectly back to Dubai, a region not just embracing crypto, but it seems proactively tackling its future challenges. Let's delve into a significant report from the Dubai Financial Services Regulatory Authority, the DFSA. This report explores crucial regulatory insights into cybersecurity, artificial intelligence, and even quantum risks. They're really trying to look around the corner at the biggest challenges facing digital finance.
They really are. This is a genuinely forward-thinking report. Let's break it down. On cybersecurity, it highlights, unsurprisingly perhaps, increasingly sophisticated threats. Things like double extortion ransomware, where they steal your data and lock its supply chain attacks, and these living off the land or LOTL attacks that misuse legitimate system tools. These threats reveal systemic risks, especially tied to the heavy reliance many firms have on cloud services and third-party vendors. Concentration risk, essentially.
And AI plays a role here too, right? Both good and bad.
Exactly. AI and automation are simultaneously enhancing defenses, but also enhancing threat actor capabilities. It's an arms race. Plus, increasing geopolitical tensions are leading to more state-sponsored campaigns. The report emphasizes the evolution of cyber resilience frameworks, focusing on proactive risk identification, strong governance, and making accountability broad across financial institutions. It's about building resilience from the ground up, not just reacting. Recommendations include things like better threat intelligence sharing, mapping out supply chain dependencies, standardizing incident reporting, and running scenario-based simulations.
Okay, that's cyber. What about quantum risks? That sounds almost sci-fi.
It does. But the threat is becoming very real, according to the DFSA. The report identifies a direct threat to public key cryptography. That's the encryption securing almost everything digital, from online banking to crypto transactions using things like RSA and ECC algorithms. The threat comes from quantum computing, specifically algorithms like Shor's, which could potentially crack these current encryption standards within the next decade.
Within a decade, wow.
Yeah, and this leads to a chilling concept they mentioned called decrypt now, decrypt later. The idea is that malicious actors could be harvesting encrypted data today, even though they can't break it yet, knowing that future quantum computers will be able to decrypt it.
So data safe today might not be safe tomorrow, even if it's already encrypted.
Precisely. This underscores the urgent need for what they call crypto agility, the ability to switch cryptographic methods and early transition planning to quantum-resistant methods, often called post-quantum cryptography, or PQC. The DFSA report recommends piloting PQC in high-risk areas now. It identified gaps, though: low awareness generally, lack of inventories of where current crypto is used, and slow progress on interoperability between old and new systems. So mitigation efforts include regulatory sandboxes to test solutions, promoting cross-border dialogues, and pushing for these crypto agility programs to accelerate preparedness.
Okay, so cyber and quantum, massive future challenges. What about AI risks? We touched on it with cyber, but the report goes deeper.
It does. It notes AI's rapid integration into financial services, which is great for productivity, fraud detection, client interaction, even cybersecurity defenses, as we said. However, it also introduces novel risks, things like models that are hard to explain, the black box problem, data governance challenges, compliance concerns. And, critically, threat actors are also using AI themselves for more sophisticated phishing attacks and finding ways to evade security defenses. The report really emphasizes that explainability and interoperability of AI systems are paramount for building trust, ensuring regulatory compliance, and maintaining accountability. Regulators are pushing for transparent models, traceable data sources. They also warn about potential AI-induced systemic risks, things like shadow finance emerging from AI-driven platforms, cascading failures if interconnected AI systems go wrong, and even herding behavior among AI agents, where automated trading systems might all react in the same way simultaneously, potentially leading to market instability.
So not just individual firm risk, but system-wide risk from AI.
Right. Their suggestions for oversight frameworks are interesting. They should be principle-based, adaptive because AI changes so fast, and collaborative between regulators and industry. The goal is balancing innovation with transparency, resilience, and importantly, ethical use.
Wow, what a journey we've just taken. I mean, from the latest market movements and that subtle geopolitical pulse, through the surging narrative of tokenization, the groundbreaking moves by players like Ripple and Solana, and then capping it off with Dubai's incredibly proactive stance on these huge future tech risks, cyber, quantum, AI, it's crystal clear that the cryptocurrency and broader digital finance space is evolving at just an astonishing pace.
Absolutely. And if we try to connect all these dots, it really emphasizes the interconnectedness of these trends, doesn't it? How they're collectively shaping the future of finance and technology. What's really fascinating here, I think, is how quickly the landscape is shifting. We're moving beyond just price speculation, though that's still there, of course, towards really practical applications and building critical infrastructure. And those reports from Dubai, they especially highlight how some regulators are trying to move from being reactive to being much more proactive, looking ahead.
So thinking about all this, as real-world assets become increasingly tokenized, and traditional finance starts to truly intertwine with these decentralized systems, what new forms of value might emerge that maybe we can't even properly imagine today? And maybe more importantly, what responsibilities do we, as informed participants in this ecosystem, have in navigating both the opportunities and the very real risk that come with it? How might these innovations truly democratize access to wealth? And what fundamental challenges still remain in ensuring security and equity for everyone involved? Definitely something to mull over until our next deep dive.